FX like there's no tomorrow.
Welcome everyone to the Financial Engineering course. Today is lecture number 10. Today we will discuss two important asset classes, foreign exchange and also inflation. From the financial engineering perspective, these two asset classes are very similar. They are about the transferring funds from one currency to another one, or in the case of inflation, we are exchanging flows from a real and nominal markets. Therefore, from the modeling perspective, those two asset classes are very much alike. Why we need those processes? Of course, ultimate goal of this course is to perform evaluation of XVA and VAR calculations. This is what we want to perform. In order to achieve that, we need to be able to simulate Monte Carlo paths of multiple asset classes that possibly our portfolio may be sensitive to. So if we have a portfolio consisting of interest rate swaps or other linear derivatives, we have also inflation and FX, then we need to be able to simulate stochastic differential equations for those multiple dimensions. Because then the correlation between different stochastic differential equations is something that we would like to really see the impact on our portfolio. Of course, if we have stochastic differential equations, those equations will have volatility coefficient, because this is what's the driver for the Brownian motion. Then we need to be able to calibrate those coefficients, those model parameters, to market instruments. And if we have volatility, if we simulate process and this process has volatility, volatility is always calibrated to options available in the market. So this is the very important takeaway. If we have volatility, if we have stochastic differential equations, we always calibrate to options available in the market. If we will not do it, we will need to do it from calibration to historical data, but that's not anymore pricing under risk neutral measure, but that's pricing under the real world measure, and this is not the objective of this course. Let's take a look at the content of today's lecture. I prepared 3 blocks for today. In the first block, we start this lecture with foreign exchange. We will discuss the whole idea about exchanging money between different markets. We will go through the financing or strategy to derive our FX forward. We will have an exchange of capital, exchange of money in 2 different currencies, and that derivation will lead us to the derivation of the forward FX rate. And then we finish this first block, with a pricing of cross-currency swaps. For cross-currency swap, it's a very popular, it's considered to be long-term contract where 2 parties exchange initially notionals, and then they will pay to each other flows in different currencies. And of course, the objective of our course is to find out what is the fair value of such a contract. Imagine scenario, you have a client that they would like to hedge their risks because, for example, your client is a producer. They would like to hedge their risk associated with foreign exchange. This client has, let's say, production which happens on a regular basis. For that reason, you may consider to have a cross-currency swap contract to help your client with hedging the risks associated with foreign exchange. In the second block, we'll be talking also about FX, but here we will go more into the pricing of options. So we are talking about the tools necessary to calibrate our model, stochastic differential equations, using market instruments. So first one will be simplified illustrative case where we take Black-Scholes model and we actually evaluate option prices on the foreign exchange. The second and the third part of this block will be about extension to Heston model with this stochastic volatility model for FX, and also discussion on how to include stochastic interest rates. So not only stochastic volatility, but also stochastic interest rates and foreign and domestic measure, how to include those in the evaluation pricing of FX options. Here it is, maybe you may consider that, okay, we already have discussed Heston-Hull-White. What's special about Heston-Hull-White in FX? And actually you will see that derivations for the dynamics under the domestic measure, risk neutral measure, it will lead you to some quite surprising results regarding the so-called quantum correction that has to be included in a stochastic differential equation. So although similar approach we had before for Heston worldwide, in the context for foreign exchange, we need some extra attention and extra corrections will be included in SDEs. In the final block, we will concentrate on inflation. He will be talking about inflation forwards, inflation swaps, and also inflation year-on-year inflation. So it's a kind of performance of inflation over time. And this will be also I will show you the relation between pricing of inflation products and pricing of foreign exchange derivatives. And finally, we will wrap this lecture with the summary, and also I'll give you 3 homework assignments of this for this class. I hope you enjoy it. Enjoy the course. Before we dive into modeling, specifying stochastic differential equations, that's what we always do, let us this time start with a little bit of history on foreign exchange, which is also often called cross-currency. Foreign exchange has grown tremendously over last decennia and also centuries, and is closely related to globalization. Globalization essentially means that trade between different countries is easier accessible, and of course that also leads that each country, when you buy or sell goods and services, you have to exchange money, or you have to exchange currency for those goods. Keep in mind, currency and money, there are 2 different things. Money has a huge, biggest difference between money and currency is that money has a store of value principle and currency does not. So currency is something which cannot store value, but this we'll cover a little bit later. So the FX market of foreign exchange has grown rapidly since the First World War. Of course, if you like to learn about the history, detailed history about the cross currencies of foreign exchanges, this will be a lecture, or let's say course on its own. It's a huge history since the beginning of our civilization, whenever there was exchange between different tribes or different countries. Initially, so we concentrate here on the 20th century. This is, let's say, the start of the modern era of foreign exchange. After the First World War, all the countries around the world, or most of the countries, were linked to gold. So the foreign exchanges were linked to gold. And essentially, this means that every country that had a currency, this currency was pegged against gold. So we could say that we have a called gold standard, and each country, so the C1, C2, and C3, every country would exchange its own local currency and would express how much gram of ounces of gold would trade, and then this amount of gold will be bought or sold to the other country. So you can see that there is, let's say, there was no direct connection between country C1 and C3, but there was a gold in between. Clearer here, we have a gold. Yeah, so gold was basically a connection between different currencies, and if one country would like to trade with other one, then there was always an amount of ounces of gold that was used in between. And of course, gold standard, we are not right now on the gold standard, and the gold standard on its own has very significant limitations, especially if we talk about deficits, and also the debt market is also strongly affected by the restriction of the gold standard. Right now, we don't have any gold standard, we are complete fiat, but let's discuss it in a little bit later. So we had a gold standard until 1933. After 33, there was no gold standard anymore. So Franklin Delano Roosevelt has restricted substantial private ownership, and this is also very interesting history how this developed, that people were not allowed anymore to possess any amounts of gold. Then after the Second World War, in 1945, even earlier, all the countries, because the Second World War was about to finish, the countries around the world had to agree about a new financial system. And that was agreed in Bretton Woods, where the gold standard was resumed. And of course, if you think of multiple countries and they have to exchange gold, it is a little bit of troublesome, because then gold is not light, it's rather heavy metal. So you need to exchange those amounts of gold if you like to trade with different countries. And in Bretton Woods was agreed that a temporary dollar would play that role. So this means that instead of gold, we would use dollars that would be backed by gold. So it was basically a very efficient way of transferring goods, because if one country would like to buy goods from another country, then instead of gold, this transfer would go from one local currency to dollar, then it would be exchanged to this currency. Then in the middle, we don't have this connection, let's say, we don't have this difficulties of transporting the amounts of gold. However, on the other side, we have this gold standard. This means that every dollar that was printed, let's say, it was an equivalent amount of gold which was stored in the Fort Knox. So this means that we have a benefit that we are on a gold standard, because every dollar is backed by gold. However, on the other hand, we have benefits of using dollars because dollars are easier to handle. Moreover, we have even further so this is, let's say, quite convenient that we could, instead of gold, we could use dollar. But the best part of this setup was that if two parties would exchange goods with US, with the United States, and would, for example, export goods to the United States, would receive dollars. Those dollars, normally you would say this country would like to exchange it back to their local currencies. But in that way, if they would exchange back, this means they would need to sell dollars and buy local currencies. That would weaken local currency. And of course, if you're weakening, it would basically strengthen local currency, right? So we sell dollars, we buy local currency, that would strengthen local currency, and that would be very disadvantageous to the country, because if you sell dollars and you buy local currency, this means the currency becomes stronger. Of course, that means that you will weaken your export, because if your local currency is stronger, this means you are less attractive to the foreign investors. So what countries often did, especially exporting countries to the US, they were exporting goods, they were receiving dollars, and those dollars were exchanged, they were used to purchase governmental debt in terms of bonds. So you have seen, so this system was very attractive because first we exchange goods for dollars, which are backed by gold, and then these dollars are used for debt derivatives, which also pays interest rates. Of course, gold doesn't pay any interest rate, it's basically just a store of value. But however, this configuration here, when we use dollars, gold as a backup, and also we have a bonds as investment, then essentially the system was constructed that we had gold that paid interest rates. So that was extremely beneficial. That existed actually until 71, where Richard Nixon has stopped with gold standard. So this connection between dollar and gold was stopped. There was a long, big, very interesting history why it happened. Essentially, the problem was that the US was running huge deficits, and that would weaken the dollar. So there was no one-to-one relation between amount of dollars produced and amount of gold. So foreign countries, European countries especially, decided that they would like to exchange their dollars that they received from exporting goods. They would like to get gold. And of course, if all the countries would like to have receive their gold, that would be very disadvantageous to the United States. So in 1971, on the 15th of August, the gold standard was temporarily suspended. This temporary is until today. So since that day, we are on a full fiat. This means that countries exchange, so countries still consider dollar to be the main reserve and also the exchange currency. We call it often base currency. So if country C1 would like to get currency from C2 onwards, there will be dollar in between. This system still exists, however, is not anymore backed by gold. And also often, if you look at the credit market, if we have countries, so let's say we have a country here, and country would like to get, for example, issue bond because they would like to finance something in their country, and they have a local currency which is not very strong, it is difficult to convince foreign investors to buy this bond because essentially country could default. That's one thing. But also, if you're a foreign investor, you also have a cross currency risk because if the local currency would deteriorate, would weaken, then you're losing also on that side. So you have two types of risks that you need to handle it. So often countries also that if they issue debt, they may issue, for example, in euros or dollars. In that way, investor would be certain that he will receive his, let's say, a base currency, the currency that that he knows, for example, it's from his either country or it is without problem that it would weaken certainly. On the other hand, it's exposed to high interest rates, and of course, this for this country that has issued these bonds, it is attractive because a much higher demand for those bonds issued in dollars would exist. On the other hand, country runs also some risk because if their local currency would weaken against dollar and they have to pay in dollars, this means that the country would enter maybe some difficult time to pay by dollar. So there's a rather complicated relation between what type of bonds, what kind of currency the issuance of the bonds would take place. But this is, I think, on its own, the credit market is very interesting how those relations, how bond market works and how the payments in different currencies in relation to gold is constructed. Let's take a look further. So initially governments attempted to prescribe an exchange rate, so after removing from gold standard, to improve a country's trading position. This means that, for example, countries, once there was no gold standard, countries could control their weaken or strengthen the currency. Of course, every country would like to decrease, weaken their currency. And of course, the main driver for that is that you would like to, countries would like to improve their productions. So if there is a lot of export happening, this means that there is a lot of jobs. So of course, country benefits if the currency essentially is weaker. Of course, the downside is that if country is weak and issues debt in foreign currency, that also may be a troublesome because then weak currency, then this means there is much more currency needed to pay debt in foreign currency. And of course, this kind of lowering of the exchange rate, so weakening the currency, it would improve countries' export by making the export relatively more affordable, while import from other countries would be still more expensive. So that's also maybe to some extent could be also a weakness, because if we help our export, then the question would be what type of production in this country we are interested in. We're looking at what type of production is taking place. Because if production is intensive in terms of imports, that would be weakening the currency would not really help, because the country will need to import goods from foreign countries. This means that there is effect higher, actually the more local currency would be needed to import goods to use for production. So it's rather complicated relation whether a weak currency is better or not. In general, weak currency helps the export. However, if your industry is very much import dependent, that could basically reduce the impact of the weak currency. On multiple occasions, so this is point number 2, however, attempts of weakening currency have led to trade wars. So trade war is basically a situation when two countries fight to weaken their currency further. The issue with that is that if you have a fight with two different currencies, essentially you may destroy your own currency, and that in long term can be extremely destructive for the whole economy. So this is something to keep in mind. Nobody ever wins currency wars or trade wars where the sanctions or let's say some kind of tariffs are imposed. So that's never good for the business in the long term. And here we have, on the other hand, for currencies that depend on foreign debt, a lower exchange rate will imply higher installments to be paid, essentially if loans are taken in foreign currency. So this is also, so this is what I mentioned. This is also related to the so-called MMT, so modern monetary theory concept, where essentially this theory claims that issuance of debt does not really matter. You can finance everything in your economy. If you have necessity to spend money, you can do it. However, you should never take loans in foreign currency. And then, as long as you are taking your own currency as the debt generation, you pay in your own currency, then according to this theory, that would not have negative impact on the economy. I think many countries already have tried that, and is so far not so much successful. But it does not really still stop other countries to explore this idea further. So let's see how this will result in the future, whether it will be successful in the long term or not. Currently, the major currency exchange rates are determined by supply and demand. So this is floating. This means that exchange rates are floating. In the past, if we had two currencies and there was a gold standard, then currencies, if they were too expensive or too weak, then they had to revalue or devalue with respect to gold. And that meant that certainly it could happen that the currency would devalue 20-30%. And that would be very damaging if there is a jump in the FX market. That's very damaging for exports, for producers, for whole economy. So now we have exchange rates. So without gold standard, we also have exchange rates that are floating. And this means that every single second, every single millisecond, market supply and demand on currencies would play a role. And it represents the equilibrium. What is the perception of the whole world perception on particular relation between different countries, their economies, policies, etc. Of course, this is still exposed to some kind of manipulation. If a country you would like to use reserves, so every central bank typically keeps reserves in case it's necessary to strengthen their own currency. Those reserves could be also used to somehow manipulate those rates. This is something that we have seen it already in the past, and I'm pretty sure this will also happen in the future. Central banks still keep some gold reserves. So this is still, although we are not, we are on a full fiat, gold reserves are still present. Often it is considered to be some kind of diversificator of a central bank's portfolio. In percentage of gold reserves it varies per country. According to Dutch central bank, gold reserves are used to, in the case of a financial monetary system reset, the gold reserves will be used to restart the financial system with the, let's say, new FX, cross currency, foreign exchange rates. That will be the tool necessary for doing that. The big disadvantage of having gold, as already mentioned, is that gold is not investment that brings you yield. So it is just a store of value and does not pay you dividends. So that's a limitation of the gold standard. Of course, everything depends on what type of monetary policy is handled, whether a country behaves responsibly in terms of issuance of debt. And if you have a country that is very conservative, then of course gold maybe it's not necessary to have in your portfolio. However, if a country is irresponsible in their the fiscal and monetary policy, having maybe gold position in your portfolio, it could be beneficial. Let's say central banks do it, why investors should not do that? In this lecture, we are not going to value gold, because typically gold is considered to be exchange rate. So although gold, you can see it as a commodity, often on the trading platforms, you can see gold be exchange rate against dollar. So this comes from the history when gold was used as the cross-currency element in the FX, in the exchange rates. Now let's see how this works. So how foreign exchange works and how to exchange one currency to another. I think for many of you it is very straightforward, but let's just introduce this notion of how this exchange works, because this later will be used once we dive into the stochastic differential equations. We introduce processes for FX rate, so then it's also important to understand what is exactly meaning behind those processes. So first we have we consider euro. So this is our domestic currency. So then we have a dollar, which is our, let's say, foreign currency. Of course, you can exchange those euros to other currency, also dollar. And then we have FX rate. So this is FX rate we indicate here by Y, and then dollar to euro. This means we exchange dollars to euros, and that unit of this amount actually represents the units of domestic currency per unit of foreign currency. So how much unit of domestic currency you would receive per unit of foreign currency. So for example, here, if we have $100 and we would like to exchange this amount to euros, we multiply this $100 with FX rate dollar to euro, and then we see it's 100 times, this is 0.85. We multiply this dollar would cancel out, so we end up with 85 euros of euros, and 85 euros is equivalent of $100 using this FX rate of 0.85. So again, FX rate expresses in units of domestic currency per unit of foreign currency. This is the key element here, per unit of foreign currency. So per unit of $1, we have 0.85 of euro. So so important that in the swaps and other interest rate products, we always talked about notional. Here, the role of notional will be $100, and then we indicate this by input. So it's notional in the foreign currency. Because later we are not going to use anywhere dollars or euros. We will be just looking at the F and D, foreign and also domestic. So in notional in the foreign currency, this would be the NF dollar is equal to NF times foreign exchange rate, and this will be in our domestic currency, euro. This is the shorthand notation, so it's a Y, and we always indicate here in the index we will have a subscript, we have F, D, so this means we move from foreign to domestic. So this will be always represented in a units of domestic currency. The simplest and also one of the most liquid FX contracts is the so-called forward FX contract. This contract is equivalent to borrowing and lending the same amount in two different currencies and converting the proceeds in domestic currency. So this is something similar we have seen already for the interest rate forward, where we lend some amount of money. Here, of course, in the FX case, we always have two transactions, because one transaction will be in domestic currency and other transaction will be in a foreign currency. So we have this element of conversion of one currency to another. Since one borrows and lends the same amount, the initial value has to be zero. This is also the same way how we have seen it in the interest rate world. Of course, by equating the cost associated with borrowing and also profits associated with lending, will determine the fair value of this forward contract. So, as it is usual for a forward contract, when the forward price is equal to the forward exchange rate, under no arbitrage. So this is exactly the definition. So this forward FX exchange rate will determine the fair value, the fair forward value of the foreign exchange rate, such that the contract at the inception will be equal to zero. So here I prepared two ways of deriving this FX contract, FX forward contract. The first will be via replication, and the second one I will show you the very nice relation of very often observed and applied in a foreign exchange market. So we start with a static replication strategy for this FX forward contract, where we consider two currencies, euro and of course dollar, with the corresponding interest rates in the market. So we have interest rate in euro, interest rate in dollar, and we have, of course, so those interest rates will be R euro and R dollar respectively. So now an example here will be given on to show how this FX forward contract can be replicated. We have two times, so we have time t0 and time capital time t. So here we essentially show how these transitions of these two transactions will evaluate in time. So first what we do, we borrow $1 dollar. So this means that at the maturity, we have to return $1, and also there is an additional rate we have to pay on the top. So you see this will be amount we have to multiply with $1. and this quantity will be in dollars. On the other hand, we are lending in euros, so we have still this $1, and then we have this FX rate at time t0, so this will be transferred into euros, and at the end, what we obtain exactly what we started with, so $1 times the FX rate, and then this quantity will grow with euro rate, because this is transferred to euros. So in the money savings account, we will receive this additional factor here. This is multiplier, which shows how this amount will grow in time. Of course, please keep in mind that here we're considering deterministic interest rates. However, the principle can be extended to stochastic interest rates. Then we just have to move from exponents here to zero coupon bonds, but exactly the same strategy would apply. So we see, okay, so those are the initial points. We have here the final transaction. So we have here, we return this amount, we obtain this amount. And of course, now our objective from today's perspective is to find out what is the fair value of this YT0 such that this transaction at the inception would be equal to zero. How much, such that it will be balanced, right? Will be balanced. So, okay, so what we do, we equal those two transactions at the maturity. So here we have, this will be on the one hand side, and this will be on the right hand side, on the left hand side, right hand side, and we equal them here. And we have this forward rate, because here you see this is amount which is seen at time t0. So here, of course, this will be different quantity because we would like to see it from this amount from today's perspective, right? So this is why we have this additional factor t representing the amount of exchange rate that will not take place only at the inception, but we are equating those two transactions at the maturity. So we are looking for the forward rate. And here you see basically if we just divide everything by $1, so of course this nicely cancels out, and we discount both sides by $E$T, then we see we have forward rate for the FX rate, for this forward transaction, is equal to, we have this initial spot rate for the FX. We have two ratios of this compounded interest rate that we have received over time. And of course, this amount will equal to this zero coupon bond, because it's 1 over, and this rate of dollars will equal to here. So it's 1 over, and then we have here. So we see this is fair value of this forward FX contract. So you see, essentially, if you like to price this FX forward, we need to take today's spot rate for foreign exchange, and we have to adjust. We have to look at the ratio between rates in two different markets. So if rate in dollar and euro would be the same, you see this nicely would cancel out. So then we see there's FX forward would equal to the FX spot. However, you see that if one of the markets would have a higher interest rate, then this means that the forward rate would be growing in time because there is some strengthening of the currency takes place. So higher interest rate in domestic currency or foreign currency, higher interest rate always indicates that currency is stronger compared to the other currency. So always keep in mind that we always look at the relative strength. Of course, this is also kind of a tricky thing, because if we have two economies and two economies are performing very bad, if we compare to each other, one may be looking better than the other one. However, they are both doing quite bad. So for example, if we have central banks from both countries or around the world who are irresponsible and issuing a lot of debt or buying a lot of debt from the government, that would not be seen in the FX market. If everyone is irresponsible, that would not be clearly seen in the foreign exchange, because FX market shows relative strength. So relatively you can be fine. However, in absolute sense, you can be very much not fine. And that's something to keep in mind. So FX world always shows you the relative strength or relative weakness compared to the other markets. It's not absolute measure whether your currency is strong or weak. Of course, you can see that to some extent measure in absolute sense by looking, for example, at the value or real estate, or for example, the value of a real value storage of money, that could be, for example, gold. But that's, of course, it's a different story. And okay, and this is the second approach, how we can approach this. So this was the simple replication strategy to find out what is the FX forward rate with two markets, exchange spot rate. There's also the very famous square relation for the FX forward. And we have to basically, this is time t, time capital time t, and we will follow two different paths on how this amount in foreign, so this is notional in foreign market at time t, how we can discount, how to get value today. So first approach, we can go on the left-hand side. We could say, okay, we have this notional in foreign currency at time t. What we can do, we can discount this amount to today in the foreign market. So this will be still discounted amount in the foreign market. And then we will exchange to domestic market by multiplying with this FX rate, right? So this is discounted amount in foreign market multiplied with FX. This whole amount represents the amount discounted notional amount in foreign currency, and this is represented in domestic currency. On the other hand, what we have, if we have notional in this foreign currency, we can exchange this amount at that future date with this FX rate in the future. So you see, at that point in time, we will just exchange. And then what we'll do, so this is already now represented in a domestic, because this is NF times Y. This means this is in domestic currency. And this means we also can discount with domestic or risk-neutral money savings account. So you see those two approaches, essentially they should be equivalent. Later, I will show you the case that in practice, this is not necessarily the case, that this is not always holding. However, in this ideal, let's say, standard approach, those two approaches should be equivalent. So what we can do, we can equate them in terms, of course, of the expectations. So here we talk about CC, this discounting. Normally you should take expectation if you really want to equal something at time t, especially discount, because we always talk about discounted future cash flows. So we have to discount and then expected future cash flows. So we still have to take the expectation of those two terms. So on the left-hand side, so this was the approach where we had the foreign amount. We discount with the foreign money savings account, and then we exchange this amount to domestic. So this part can go outside of this expectation because this is measurable with respect to this filtration. This notional also it can be outside because this is just a constant amount of foreign currency. So of course we only went up with expectation of 1 over this MFT. That's simply a foreign zero coupon bond. Then we just multiply with these two terms. So this was this case where we were going this way. On the other side, we have to discount with the future FX rate. Yeah, so with exchange with the future FX rate, and then we discount to today with the domestic money savings account. And this will be done here. So we have a foreign notional, we exchange at the maturity date, we discount with the domestic, and this is taken under Q, and Q here gets domestic risk neutral measure. Of course, again, this can be taken outside. This, however, none of those terms can. What we can do here, we can change measure from risk neutral or domestic risk neutral measure to domestic forward measure. This is what is indicated here in this T measure. So this zero coupon bond, this money savings account becomes a zero coupon bond. And then we have this expectation here in this case. So this is exactly what we have seen forward rate represents. So this was in the previous approach. We had this forward rate here, forward FX rate, which represents here the expectation of the FX rate in the future under the T forward measure, domestic T forward measure. And of course, now we have those two approaches. So we have this case and also we have this case. Now we have to equal them together. And then what we have, so this is something similar to what we had before. So those two notionals will cancel. We have an FX rate today. So this is constant. We have some zero coupon bonds and this expectation. So our forward rate is equal to the expectation of the future FX rate. And then if we just substitute everything nicely to this expression, this of course will cancel out. And then we arrive the same equation that we have seen from the replication approach. So the forward rate is equal to the spot rate, and then we have this adjustment according to the strengthening of the currency. So this will be interest rates of the foreign and domestic rate. So this is our forward rate in the FX world. As you can see, for example, if we would not have FX, then there will be just basically we will have one of those zero coupon bonds. So this is something we have already seen in the case of a LIBOR rate, or for example, forward rate agreements that were discussed in the interest rate case. One more thing to mention is that unfortunately the square relation that I have just shown here, doesn't really hold in reality. There is some additional effect that is not really presented there, and that's called so-called a basis spread. Basis spread means essentially that the relation doesn't really hold, and this why it doesn't hold is because there is a demand and supply for certain currencies. So some currencies you may be willing to have it. Your preference to a dollar or to euro may differ depending on the market circumstances. So, for example, if there is a market prices, so there's a crash in the market, all the economies typically would like to protect themselves and then would like to request dollars because that's the currency which is, let's say, the global currency in the world. So then the demand for some currencies could be higher or lower depending on the market circumstances. And of course, that has to do with also there is a time value of the preference. So whether you will have an FX rate in the future or FX rate today, that depends on the perception of particular currency. So this means that this relation doesn't really hold. It's very close, but it's not perfect. And some adjustments need to be taken, and this is called basis spread adjustment. So we have those zero coupon bonds; those will be taken purely from the markets, and then we have to adjust with it's called ZFs, so the Z spread or basis spreads for those two currencies, and those will be just like a zero coupon bond. So this is the same approach you could use to adjust those zero coupon bonds. So of course, if your zero coupon bonds were constructed by peeling of a yield curve, the same strategy would apply to those spreads, and those would also need to be implied from market instruments available in the market. So also special instruments that will allow you to estimate what is this additional spread you have to take into account. Just like in the interest rate world, where we had interest rate swaps, we can also exchange money, or we can exchange flows between different currencies. And for that reason, we have so-called cross-currency swaps. So it is very much like what we have seen already before in terms of interest rate swaps, where we exchanged float LIBOR rate against a fixed rate. Here, if we add this additional FX or cross-currency effect, there we have more combinations on the particular configuration of this trade. So let's take a look. So a cross-currency swap is typically long-dated FX product. When we talk about short-dated products, those are typically products with maturity up to 3 years. It's typically what you should think of once we talk about short maturity or long-dated, long maturity contracts. Long-dated basically means so longer than 3 years. That's typically the notion. And this contract enables us to a corporate to transform a loan in one currency, the funding currency, into a loan in another currency. So essentially, this type of derivative, you can think it is not maybe always for speculation. If you would have a company that produces some tools or some products in one country, and then those products are exported, let's say, on a frequent basis to other country. So, for example, there is a contract between two different companies. Then, in order to hedge the cross-currency risk, then a cross-currency swap would be suitable for this kind of purpose. So this is, when you think about international market, this is very important and also very fundamentally sound contract that it can be applied in many different occasions. An FX swap, similar to standard swap, but there are a few exceptions. We have first that there are different day count functions because we are dealing with flows from different countries, from different FX rates or different currencies. Then the day count fractions typically would be different. Also, already once we talk about the IR swap, so we have exchange. So in a standard IR swap, we would exchange LIBOR rate for strike, and then we had this in the lecture. I showed you we had this accrual where we multiplied. But in practice, also in this interest rate swap case, this would be actually something like we have a sum of all the flows. We have an accrual for LIBOR, so let's call it L. And let's make it L bar minus L star K. So that would be typically already in the interest rate world. The accruals would depend on type of a leg we have. So in the terms of a float leg, so the floating part, the accruing periods could be different than we have for the fixed part. And this can be also those frequencies of those payments could be different. So for example, we could have 6-month LIBOR. This means we have payments on the float side. In this case, we receive on a 6-month basis. However, the fixed rate payments are happening on the higher frequency, for example, 3 months payments. So all these configurations are also possible already in the standard interest rate swap. Of course, in this lecture, we didn't discuss the details. Those are, let's say, technicalities, technical extensions, but the principle behind pricing is exactly the same. So in cross-currency swaps, that will be also the case where we have different day count fractions for different configurations of those cross-currency swaps. What is also something that we actually haven't seen in interest rate swap is that in cross currencies, we always talk about exchange of the notional. So, for example, you have two counterparties, and they first initially, at the inception of the contract, they would exchange, for example, $1 million for €1,000,000, and then the contract, let's say, there are some regular schedule of flows that they would have. So initially, for example, if you are in a production business, you would acquire, let's say, $1 million, although the company is in Europe, and that you would use that dollars for some production purposes, and then you enter the swap, and then over the lifetime of the swap, you'll be paying the interest on your loan, and then at the end of the maturity of your contract, you would exchange back the notionals. Some details about that I will show you in the next slide. And also there are multiple different combinations that we can have. We can have, for example, fixed for fixed. So in this case, we will have we pay fixed rate in one currency, and we receive fixed rate in another currency. Also, we have also fixed float, float fixed, float float. In this one, for example, we would be receiving float interest rate. So this means LIBOR rate in, let's say, dollar against LIBOR rate in USD. So those are kind of indices associated with the economies. Yeah? So this would be float float, float fixed, fixed float. So of course, different combinations here because we may be paying fixed or receiving fixed. So those are also all possible variants. This is an illustration of those cash flows. So here I have presented very simple fixed for fixed. So we receive fixed flows and we will pay fixed flows, of course, in those corresponding currencies. So how does it look like? Oh, sorry. So how does it look like? At the inception, we are here, we will receive notional in the foreign currency, and we will exchange with the counterparty notional in domestic currency. And now, so this is the money we paid out. So this is what we received, and this is what we gave away. And of course, on the amount that we gave away, so somebody received this amount, we will receive interest of that amount. So this is what we have here. So we receive a notional in a foreign, and then over the lifetime of the contract, we have to pay a rate of that notional. So this is why we have NF here. And then this is what we receive. And then we pay accrual times the notional times this rate. So this is the first payment we do, second payment we do, and so on. And at the end, we will have to, you see, we have to exchange. So we received this notional at the beginning. Now we have to pay it back. And we also have to pay this interest. So in the last payment, the contract, we are not only exchanging the notional, but we also have this remaining payment over this period of time. So this is what is included here. And from the other side, we have here, we gave, so from this side we see, we gave away notional and foreign, we received notional and domestic. So every time, so let's make, every time we have to pay, so if we receive this, we have to pay this amount, the proportion of this received notional in this domestic currency. So you see, actually, we start with NF, ND, ND, ND. This is the interest over the amount we gave, and this is what we received, and then this is what we have to pay. So this is kind of an alternation of the payments. You have to be, of course, very careful because those cash flows are very important. So, for example, here we pay always the interest over the amount that we have. So this is what we received, what we gave away. So this is what we received. So you have to think of carefully about pluses and minuses. And at the end, of course, the ultimate goal is, okay, we have cash flows in different currencies. We receive something in domestic, we pay something in foreign. At the end, we have to value this contract. And of course, we have to incorporate this FX rate that's going to be used to transfer this foreign payments into domestic payments. So this is something that we will do right now. So here's the structure. So to value this payoff, in this actually representation, excluded the initial notional. So those payments here are excluded because essentially they don't really play a role. This is just a deterministic exchange. So at this point, we know exactly what amount we receive. So it doesn't really play a role in the evaluation. Also, there is no stochasticity because there is no discounting, because this just takes place today at time t0. And so we have a cash flows from the next period until the maturity -1. So this is until this last moment here. We will do the following. We have discounting from those periods. We have tau d and d AD. So this is the interest that we will receive on this ND, and this is what we have to pay. So we pay notional in a foreign, we multiply with accruing. We have a strike, so we have this rate over this notional with accruing, and then this amount at time ti has to be exchanged to the domestic. So this is already in domestic. This is also in domestic because this is what we receive in domestic currency. So this means we have to discount this whole amount from time ti to today with a money savings account from domestic currency. So this is risk neutral domestic, so money savings account in domestic currency. And then we have this final payment. So you see there is a big bracket. It's still everything is under one expectation. We have here, again, we discount from the final payment. And then it's almost the same as here, except that those two payments will be also including the notional that we will receive on exchange back. But still this exchange will take place at the end. And also here, this FX also needs to be included in this valuation. Okay, so we have to find out what is the present value of this contract. So let's take a first refresh what we have seen before. Because here we have, of course, this expectation can go under the summation. And we end up with, you see, there will be there will be FX rate and also discounting part. So this is what we see here. So it's a foreign to domestic, and we discount with domestic under domestic measure. We can change to the forward measure, and then we have a discount factor in the domestic measure times this expectation of the forward, the FX rate at time t. But this is under t forward measure, and this is what we already have seen previous slide. That this is equivalent. This is a forward FX forward rate, and this is the equation. Of course, here we see it's a cancels nicely out. So we end up with an FX rate today times the foreign discount factor. So we have to be very careful about those F and Ds, because you see here we have an amount in domestic. So we always look what we take expectation on the domestic measure. We have a 1, it's in foreign. We exchange it to domestic. We discount to domestic. What we have here, we have foreign zero coupon bond. but we multiply with FX rate. So this means we bring this whole amount into domestic currency. So this FX would change foreign amount to domestic. So of course, this is also domestic, this is domestic, nice sanity check, everything seems to work. And of course, now if we put this expectation under the summation, and we know, of course, this part is trivial because this is constant, so we only end up with a zero coupon bond in the domestic, so domestic zero coupon bond times those payments. And then for the other side, we have this expectation everywhere. So we would end up with a foreign bond times those amounts. And here we have this exchange rate. So here, should maybe put F and D here. This will be easy to get here. So keep in mind that those two zero coupon bonds, they're different. So this one is in domestic currency, this one is in foreign currency. So of course, after the substitution and you collect all the terms, this is the final result we obtain. And of course, the same would hold for the notional exchange that takes place at the final payment date of this cross-currency swap. So you see, pricing of cross-currency swaps, it requires some attention with regards to the exchange rate that you have to take into account. You also need to be aware, you have to remember the definition of the FX forward rate. That's also is given here. In practice, you also need to include cross-currency basis spread. So this is something I have just discussed a few seconds ago in the previous block. And then if you put those together, you will see you receive the full amount. This is the value of a swap expressed in domestic currency. So this is the value as seen from our perspective.